Hey everyone, and welcome back to the channel. Today, we're tackling a topic that might just be the most insidious financial trap lurking in plain sight. Your credit card's minimum payment. Did you know that by consistently paying just the minimum on your credit card, you could be setting yourself up for financial devastation, costing you tens of thousands of dollars, and extending your debt for years, even decades? It's a harsh truth, but it's one we need to confront head-on. We're not just talking about a minor inconvenience here. We're talking about a strategy that banks love, but one that can utterly destroy your financial future. It's a silent killer, slowly but surely draining your wealth and your peace of mind. In this video, we're going to pull back the curtain on why paying only the minimum on your credit card isn't just a bad idea. It's financial suicide. We'll uncover the hidden costs, the extended timelines, and the real-world impact this habit has on your life. More importantly, we'll equip you with practical, actionable strategies to break free from this cycle and regain control of your financial destiny. So, if you've ever felt stuck with credit card debt, or if you simply want to understand the true cost of those little minimum payments, stick around. This video could be the most important financial lesson you hear all year. Let's dive in. Before we dissect why it's so dangerous, let's get crystal clear on what the minimum payment actually is. For many, it seems like a small, manageable number, a helpful option when money is tight. But don't let its humble appearance fool you. It's often designed to keep you on the hook, not to help you pay off your debt quickly. What is it? Really? Generally, your credit card minimum payment is either a small percentage of your outstanding balance, typically somewhere between 1% and 3%, or a fixed dollar amount, usually around $25, whichever is greater. So, if you owe $5,000 and your minimum payment is 2%, you're looking at a $100 payment. Sounds manageable, right? That's exactly what credit card companies want you to think. The critical misunderstanding here is that many people view this minimum payment as the recommended or sufficient amount to pay. They think, well, if the bank says this is the minimum, it must be okay. I'm doing what I'm supposed to do. This couldn't be further from the truth. It's a calculated number, carefully determined to ensure that while you're technically making payments and avoiding default, the bank is maximizing its profit from the interest you accrue. Think about it. Who truly benefits from you only paying the minimum? Not you. It's the banks, the credit card companies. They thrive on the interest payments. The longer you carry a balance, the more interest you pay, and the more profitable you become for them. It's a business model built on your prolonged debt. To put it in perspective, imagine you borrowed $1,000 from a friend. If they said, just pay me $10 a month until it's gone, you'd probably think, that's going to take forever. Well, credit cards are even more insidious because they add a hefty interest rate on top of that. The minimum payment is a convenient illusion, making you feel like you're making progress when, in reality, you might be barely treading water. It's crucial to understand this fundamental truth before we explore the deeper consequences. This is where we get to the heart of the matter. The reasons why minimum payments are so destructive are multifaceted, each contributing to a cycle that's incredibly hard to break. Let's start with the most powerful force in finance, often called the eighth wonder of the world when it works for you, but a devastating destroyer when it works against you: compound interest. On a credit card, compound interest means you're not just paying interest on your original balance, you're paying interest on the interest that is already accumulated. It's like a financial snowball rolling downhill, getting bigger and faster with every rotation. Imagine you have a credit card balance of $5,000 with an average interest rate of 20% APR, which is quite common in the U.S. Today, especially if your credit isn't perfect. If you only pay the minimum, let's say it's 2% of the balance or $25, whichever is higher, in the first month, your minimum payment might be around $100, but a significant portion of that $100 isn't even touching your principal. It's going straight to interest. The remaining balance continues to accrue interest, and that interest then accrues interest. Let's run some hypothetical numbers to truly grasp this. With a $5,000 balance at 20% APR, if you only pay the minimum, which is usually a small percentage of the outstanding balance, let's use a common 2% minimum payment, or $25, whichever is higher. For this example, your first minimum payment might be around $100. Of that $100, a huge chunk, perhaps $80 or more, could go to interest alone. Only $20 or less actually reduces your principal. The next month, you owe interest on nearly $4,980, not $5,000. It takes an agonizingly long time for the principal to shrink, meaning you're paying a massive amount of interest for an extended period. Many online calculators can demonstrate this powerfully. Go to a credit card payoff calculator and plug in $5,000 at 20% APR, then select minimum payment. You'll often see that it could take you over 20 years to pay off that $5,000, and you could end up paying over $10,000 or even $15,000 in total just for that initial $5,000 debt. That's double or even triple the original amount. This isn't theoretical, it's the cold, hard math of compound interest working against you. It's truly a silent killer because you don't feel the full impact until years later, when the total cost becomes staggeringly clear. Following directly from the power of compound interest is the severely extended repayment period. When most of your minimum payment is eaten up by interest, very little goes towards reducing your principal balance. This means the time it takes to pay off your debt stretches out for an uncomfortably long time. Consider that same $5,000 debt at 20% APR if you were aggressively paying it down, say $250 a month. You could be debt-free in about 2 years. That's a challenging but achievable goal. However, if you're stuck paying just the minimum, that 2-year timeline explodes into potentially 15, 20, or even 30 years. Imagine paying for groceries you bought today for the next 2 decades, or a dinner out that you're still paying for when your kids are in college. It's an absurd proposition. Yet it's the reality for millions of Americans trapped in the minimum payment cycle. This prolonged debt has real consequences. It means years of your income are diverted to servicing old debt instead of being used for your present or future. It's money that could have been saved, invested, used for a down payment on a home, or put towards your retirement. Instead, it vanishes into the black hole of credit card interest. The longer you carry that debt, the less financial freedom you have to build wealth and achieve your goals. It's a slow, steady erosion of your financial future. This point ties all the previous ones together. The combined effect of high interest rates and an extended repayment period leads to a skyrocketing total cost for your original purchases. What might have seemed like a harmless $1,000 splurge can easily morph into a $2,000 or $3,000 expense once all the interest is factored in. Let's reiterate our $5,000 example at 20% APR with minimum payments. As mentioned, it's not uncommon to end up paying $10,000, $12,000, or even more over 2 decades just to clear that initial $5,000 balance. That means you're essentially paying double or triple for items that depreciated years ago, for experiences that are long forgotten. This isn't just about money, it's about opportunity cost. That extra $5,000 or $7,000 you paid in interest could have been invested in a Roth IRA, contributed to a down payment on a house, used for further education, or even just for a well-deserved vacation. Instead, it evaporated, going straight into the pockets of the credit card company. This is why we call it financial suicide. You're effectively destroying your own financial potential by throwing money away on interest. Every dollar you pay in interest is a dollar you can't use to build wealth or secure your future. You might think, well, I'm making my minimum payments on time, so my credit score should be fine. Right? Not entirely. While consistently making on-time payments is crucial for your credit score, simply paying the minimum can still negatively impact it in a significant way. Through your credit utilization ratio, Your credit utilization ratio is the amount of credit you're using compared to your total available credit. For example, if you have a $10,000 credit limit across all your cards and you carry a $5,000 balance, your utilization is 50%. Lenders like to see this ratio kept low, generally below 30%. The lower, the better. When you only pay the minimum, your balance barely budges. This means your credit utilization remains high month after month, year after year. A high credit utilization ratio is a red flag to lenders. It suggests you might be over-reliant on credit and potentially a higher risk. As a result, your credit score can suffer. Why does a lower credit score matter in the U.S.? It matters for almost everything. Mortgage rates. A lower score means higher interest rates on your home loan, costing you tens of thousands more over the life of the mortgage. Car loans. Same for auto loans. A lower score translates to higher monthly payments. Renting an apartment. Landlords often check credit scores. A low score could mean you're denied an apartment or have to pay a larger security deposit. Insurance premiums. Auto and home insurance companies often use credit scores to determine your premiums. Even job applications. Some employers in sensitive positions may check credit as part of their background checks. So, while you might be responsible enough to make minimum payments, you're inadvertently damaging your credit health, which can have far-reaching and expensive consequences in various aspects of your life. It limits your financial opportunities and can cost you more money in the long run, even on things unrelated to your credit card debt itself. Beyond the purely financial costs, there's a massive, often underestimated burden: the stress and anxiety that come with persistent credit card debt. This isn't just about numbers, it's about your quality of life. Living under the weight of debt can be incredibly draining. The constant worry about making ends meet, the fear of unexpected expenses, and the gnawing feeling that you're stuck can lead to anxiety and depression. The psychological toll of debt is real. It can manifest as constant worry, sleepless nights, irritability, and even clinical depression. Strained relationships. Money is a leading cause of conflict in relationships. Debt can create tension, arguments, and even resentment between partners. It can make family planning, like having children or buying a home, seem impossible. Limited opportunities. Debt shackles you. It prevents you from taking risks, pursuing dreams, or seizing opportunities. Want to start a business? Debt says no. Want to go back to school? Debt says no. Want to travel? Debt says no. It restricts your freedom and keeps you tethered to a cycle of earning just to pay off the past. Physical health issues. The chronic stress associated with financial struggles can lead to a host of physical problems, including high blood pressure, heart disease, digestive issues, and weakened immune systems. Imagine constantly checking your balance, feeling a knot in your stomach every time a bill arrives. That's the daily reality for millions stuck in the minimum payment trap. It's not just a financial problem, it's a mental and emotional health crisis for many. Escaping this cycle isn't just about saving money, it's about reclaiming your peace of mind, your relationships, and your ability to live a full, unburdened life. The freedom from debt is priceless, and it's a freedom that minimum payments actively deny you. It's easy to dismiss these warnings if you feel like your situation isn't that bad. But recognizing the early signs of being trapped in the minimum payment cycle is crucial for intervention. Here are some red flags to watch out for. You can only afford the minimum payment. If your budget is so tight that you genuinely can't pay more than the minimum each month, that's a clear sign you're overextended. You're using credit cards for everyday essentials. If you find yourself swiping your credit card for groceries, gas, or utility bills because you don't have enough cash, you're using credit as an income substitute, which is a dangerous path. You're opening new credit cards to pay off old ones. This is known as debt shuffling or robbing Peter to pay Paul. It might offer a temporary breather with a lower introductory APR, but it doesn't solve the underlying problem and often just delays the inevitable, potentially leading to even more debt. You don't know exactly how much credit card debt you have. If you're avoiding looking at your total balance, it's a sign you're in denial and losing control. You avoid opening your credit card statements. This is a classic avoidance tactic. Ignoring the problem won't make it go away, it will only make it worse. You frequently hit your credit limit. Maxing out your cards means you have no financial breathing room and likely high credit utilization. If any of these resonate with you, it's a strong indication that you're either already caught in the minimum payment trap or rapidly heading there. The good news is, recognizing the problem is the first vital step towards solving it. Okay, we've established the problem. Now, let's talk solutions. Escaping credit card debt isn't always easy, but it is absolutely achievable with discipline, a plan, and persistence. Here are the most effective strategies. This is non-negotiable. If you are struggling with credit card debt, the absolute first step is to stop adding to it. Put your credit cards away. Freeze them in a block of ice. Put them in a safe, or even cut them up. The temptation to use them for emergencies or impulse purchases is too high. For a period, you need to rely solely on cash or a debit card for all your purchases. This forces you to confront the reality of your spending and ensures that every dollar spent is a dollar you actually have. This simple act immediately stops the bleeding and prevents your debt from growing larger while you work on paying it down. You can't fill a bucket with a hole in it, and you can't pay down debt if you keep adding to it. Once you've stopped using your cards, the next crucial step is to understand where your money is going and to find ways to free up cash. Create a detailed budget. There are many apps and online tools that can help with this. Or you can simply use a spreadsheet. Track every dollar for at least a month. Track every single penny you spend. You might be surprised where your money is actually going. Identify unnecessary expenses. Look for fat in your budget. Are there subscriptions you don't use? Dining out too often? Excessive entertainment costs? Even small cuts add up. Think about things like bringing coffee from home instead of buying it daily, cooking at home more often, canceling unused gym memberships or streaming services, finding cheaper alternatives for utilities or phone plans. Prioritize debt repayment. Every extra dollar you free up should go directly towards your highest interest credit card debt. This isn't about deprivation forever, but about intense focus for a season to achieve financial freedom. This might mean making some difficult choices and sacrifices in the short term. But remember, it's temporary, and the reward of being debt-free is immeasurable. Once you have extra cash flow, you need a strategic way to attack your debt. There are two popular and highly effective methods. The debt snowball method. How it works. List all your credit card debts from the smallest balance to the largest, regardless of interest rate. Make minimum payments on all cards except the one with the smallest balance. Throw every extra dollar you have at that smallest debt until it's paid off. The benefit: once the smallest debt is gone, you take the money you were paying on that card and add it to the minimum payment of the next smallest debt. You literally snowball your payments, gaining momentum and psychological wins as each debt is eliminated. Why it's popular? It's highly motivating. Paying off a small debt quickly gives you a huge boost of confidence to keep going. It's ideal for those who need to see tangible progress to stay motivated. The debt avalanche method. How it works. List all your credit card debts from the highest interest rate to the lowest, regardless of the balance size. Make minimum payments on all cards except the one with the highest interest rate. Attack that high-interest debt with every extra dollar you have until it's paid off. The benefit: once the highest interest debt is gone, you take the money you were paying on that card and add it to the minimum payment of the next highest interest debt. This method saves you the most money in interest over the long run. Why it's popular? It's mathematically the most efficient. If your primary goal is to save money on interest, this is the method for you. Choose the method that best suits your personality and motivation. The key is to pick one and stick with it consistently. A balance transfer can be a powerful tool, but it's like handling nitroglycerin. It can be explosive if not handled correctly. How it works. Many credit card companies offer introductory periods with 0% APR on balance transfers. Typically for 12 to 21 months, you transfer your high-interest debt from one card to this new card with the promotional 0% interest rate. The benefit: this gives you a breather from interest payments. Every dollar you pay during the promotional period goes directly to reducing your principal, which can accelerate your payoff significantly. Crucial cautions: balance transfer fees. Most balance transfers come with a fee, typically 3 to 5% of the transferred amount. Factor this into your decision. The expiration date: the 0% APR is temporary. If you don't pay off the transferred balance before the promotional period ends, any remaining balance will revert to a much higher, often retroactive, interest rate. This is where many people get into trouble. No new spending. Do not use the new balance transfer card for new purchases. That defeats the entire purpose. And if you've transferred a balance from an old card, do not start using that old card again either. A balance transfer is a strategy to accelerate debt repayment, not a solution to overspending. It only works if you are disciplined, have a solid plan to pay off the transferred amount before the promotional period ends, and commit to not accumulating new debt. If you're truly struggling and find yourself unable to even make minimum payments, don't bury your head in the sand. Call your credit card company. Seriously, they would rather get some money from you than none at all. Explain your situation honestly. You might be able to negotiate a lower interest rate. Sometimes just asking can work, especially if you have a good payment history, even if it's just minimum payments. Set up a hardship plan. They might offer a temporary reduction in your interest rate or monthly payment, or even waive some fees. If you can prove financial hardship, be polite but firm. Have your account information ready. This isn't guaranteed to work, but it costs you nothing to try and could save you a significant amount of money and stress. If your debt feels overwhelming and you can't seem to make progress on your own, it might be time to seek professional help from a nonprofit credit counseling agency. What they do: these agencies look for ones accredited by the National Foundation for Credit Counseling. NFCC offer free or low-cost counseling. They can review your financial situation comprehensively, help you create a realistic budget, develop a personalized debt management plan (DMP) where they negotiate with your creditors on your behalf for lower interest rates and a consolidated monthly payment, educate you on better financial habits. Key takeaway: this is not debt consolidation or bankruptcy. It's a structured plan to help you pay off your debts, often with reduced interest rates, while you receive guidance. It's a powerful tool for those who need a structured approach and professional support. Be very cautious of debt settlement companies that promise to reduce your debt for a fee, as they often have negative impacts on your credit and can leave you in a worse position. Stick to reputable nonprofit credit counseling. Escaping credit card debt is a huge accomplishment, but it's only half the battle. To ensure you stay debt-free and build lasting financial security, you need to cultivate healthy financial habits. This is your financial safety net. A robust emergency fund, typically 3 to 6 months of essential living expenses saved in an easily accessible savings account, prevents you from falling back on credit cards when unexpected expenses arise. Car breaks down, lost your job, medical emergency. Your emergency fund covers it, not your credit card. This is absolutely critical for breaking the debt cycle for good. Once your high-interest debt is gone and your emergency fund is growing, start redirecting those debt payments into savings and investments. This is how you build wealth and secure your future. Contribute to your 401k or IRA. Open a brokerage account for long-term investments. Save for a down payment on a home or a child's education. Shift your mindset from paying off the past to investing in your future. Once you're debt-free and financially stable, you might choose to reintroduce credit cards into your life. If you do, it must be with a new, responsible mindset. Pay off your statement balance in full, every single month. Never carry a balance. This means you avoid paying any interest whatsoever. Only charge what you can afford to pay cash for. If you don't have the money in your bank account, don't put it on the card. Use them strategically for rewards cashback, travel points, or to continue building an excellent credit history. If you find yourself slipping back into old habits, cut them up again. It's okay not to have credit cards if they are a temptation. They are a tool, not a necessity for everyone. We've covered a lot today, from the insidious nature of compound interest to practical steps for breaking free. The core message is clear. Paying the minimum on your credit card is a destructive path that leads to prolonged debt, exorbitant costs, damaged credit, and immense stress. It truly is financial suicide. But here's the empowering truth. You have the power to change it. This isn't a problem without solutions. It requires understanding, discipline, and a commitment to taking control. So, here's my challenge to you today. Pull out your latest credit card statement right now. Look at your balance. Look at the interest rate. And look at the projected payoff time if you only pay the minimum. Let that number sink in. Commit to a plan. Whether it's the debt snowball, debt avalanche, or seeking professional help, choose a strategy and start today. Start cutting unnecessary expenses and direct every extra dollar towards your debt. The journey to financial freedom from credit card debt isn't always easy, but it is one of the most rewarding journeys you'll ever undertake. Imagine the peace of mind, the opportunities, and the sheer joy of living without that heavy financial burden. It's absolutely worth it. If this video helped you, please give it a thumbs up. Subscribe for more personal finance tips, and share your own experiences or questions in the comments below. We're a community here, and supporting each other is key. Remember, your financial future is in your hands. Don't let minimum payments dictate your destiny. Take action and reclaim your financial freedom. Thanks for watching.